If you watch financial news even occasionally, you've probably heard the same dramatic phrase over and over again. $58 billion wiped out today. 136 billion destroyed yesterday. 5 trillion in market value erased in just 3 weeks. It sounds terrifying, like money is literally burning and disappearing into thin air. But here's the truth. In most cases, that money never existed in the first place. Those shocking headlines aren't written to educate you. They're written to scare you. What they really mean is that the market capitalization of a company, the total value of all its shares multiplied by the last trade price, has changed. Take Nvidia as an example. About 24 billion shares outstanding. At $170 each, that's roughly $4.1 trillion in market cap. If tomorrow those shares traded at 85, the headlines would scream, $2 trillion gone. But Nvidia didn't actually lose $2 trillion in cash. It's just a new calculation. So where does that money go? The simple answer, nowhere. When someone sells their stock, they still receive cash from a buyer on the other side of the trade. The difference is just in the price. The bigger question is not where the money went, but what happens with that cash next. Does it flow into gold, into real estate, into bonds, into crypto, or does it just sit in a bank account, waiting? And here's the real issue. In today's world, there are fewer and fewer safe havens for that money to hide. Gold is at record highs. Real estate is risky with today's interest rates. Crypto is more correlated with stocks than ever. Even government bonds, once considered untouchable, no longer feel safe. That's why investors are chasing returns everywhere, and why markets feel so unstable. But here's something most headlines never tell you. The biggest buyers of stocks aren't households like yours or mine. They're the companies themselves. In 2024 alone, corporations spent over $1 trillion buying back their own shares. That's 6 times more than what individual households purchased. This is one reason stock prices have been so inflated. Companies are essentially bidding up their own value. But it also makes the system fragile, because if those buybacks stop, demand could collapse overnight. And here's the kicker. The top 10% of households now own over 90% of all stocks. So, when regular investors panic and sell during downturns, there's almost always someone wealthier waiting to scoop up assets at a discount. This creates a market that can stretch higher, longer, and more irrationally than ever before. But it also makes the divide between the wealthy and everyone else even larger. Think of money like piles. One pile is consumption, and cars, vacations, groceries. Another pile is assets, stocks, real estate, bonds, gold. The wealthy already max out what they need for consumption. So every extra dollar goes into the asset piles. Those assets generate returns, which then get reinvested, creating a feedback loop that compounds wealth faster and faster. Meanwhile, most people live paycheck to paycheck, tied to wages that grow far slower than asset prices. This matters today more than ever, because trillions of dollars are flooding into one area in particular: artificial intelligence. Companies are spending enormous sums building AI infrastructure, chasing the next big breakthrough. Stock buybacks, AI investments, and concentrated wealth all combine to make today's markets look more stretched than ever. And the big question isn't just what happens when the green line goes down, it's whether the entire system of how we measure wealth is broken. So the next time you hear that billions were wiped away in a crash, remember that money didn't actually vanish. It was just repriced, moved, or shifted to another pile. The real challenge is figuring out where it flows next and how that impacts your future. And if you want to understand how the AI boom is already shaping these money flows and how it might affect you directly, don't miss the next video. Make sure to like, subscribe, and keep learning how money really works.